All right, welcome back to the final round here on Yahoo Finance. Miles Allen with you in New York. Let's turn our attention now to the markets and really what happened over the last couple of weeks with that short, brief, but pretty steep correction in the S&P and the NASDAQ. For more on that, we're joined by Omar Aguilar. He's the Senior Vice President and CIO for Equities and Multi-Asset over at Charles Schwab. Omar, thanks so much for joining the program. So let's start with how you were thinking about that period we saw in the last couple of weeks. And I guess I would ask, are we still in a corrective phase in your view?
Well, we're still in the process of higher volatility levels, and we should expect higher levels of volatility for the remaining of this year. It is not a surprise that we saw the activity that we saw last week, particularly from the leaders of the market so far, which is mostly technology. It is very common to just get to that point where, after a very optimistic view in the summer with all the conditions getting to just an incredible rally, that all of a sudden people start to rethink twice about the reasons why they have those positions. In other cases, because you have the possibility of all the uncertain conditions that we have going into the rest of this year. What is interesting is that, the way that people are processing information seems to be shaping up the volatility of the day. Days like today, when you have deals, when you have promising vaccines, when you have a little bit of a calm economic data, all of a sudden triggers, again, a rebound in the market. So we're going to see a little bit more of that traditional high levels of volatility that are typical of a bull market. I would probably say that corrections like the ones we saw last week are very typical. Especially when you see the trends going in through, the rest of the year.
Well, so then I guess the natural follow-up to that would be if you look at the broader phase of this market, maybe sort of what began in March and April, it sounds like you're comfortable calling that maybe a new bull market of sorts.
Well, it is clearly well defined as a bull market, even technically speaking, with the run that we saw since the bottom, in March. Now, I think what we have to be careful, though, is that the gap between the market and the economy gets bigger and bigger. While we see the economy is starting to recover and we're on the wood pace to recover, the market is always way ahead of what the economic data may suggest. And in a certain way, that's something that we need to just be careful and watch. The majority of recessions, usually, end and the market is ahead of the economic recovery. Now, that usually in most of the cases, even in the one we saw in 2008, it starts by fixing the source of the recession. Back then was a financial crisis. Well, right now, we still haven't figured out the original source of this recession, which was the health crisis and the coronavirus. So I think a lot of what the gap is and the pace for the economic data to catch up with the speed of the market, it will have to be when we get a serious path forward for the coronavirus crisis.
And then you mentioned, earlier that given the performance in some of those sectors that have really driven this rally, it would make sense that we'd see maybe some cooling off as we saw the last couple of weeks. But when you think about sector styles, factors that you like right now, are these still the areas of the market that seem most attractive in this environment?
Yes, it is. We've been very, very clear here at Schwab that the rotation towards value, which is really typical once you see a solid recovery in economic data, has not yet started. And a lot of that has to do with the fact that, if you see the leaders so far, when you have growth and you need to have EPS growth, when you see top line growth, especially for those big winners, we continue to see that high quality growth companies continue to drive the market forward. That has not changed, and it's going to be hard to change as we actually see, the solution to this. And if you look at those top line growing companies, those are the ones that tend to have the benefits of the working from home, of the working out from home. All those companies that have adopted to the new conditions of the market clearly have actually the opportunity to raise their EPS and continue to have the top line growth on top of the fact they're generating tons of cash flow. So it is very hard to imagine at what time we're going to get the rotation into the more cyclical names, especially because we need some sort of a change in the structure of that coronavirus or that recession source.
All right, Omar Aguilar with Charles Schwab. Thanks so much for taking the time. It was great to get your thoughts.
Thank you.